Hello and welcome to a new virtual investment summit by Fund Society. Today we are welcoming Jorge Corro. He is head of the US Offshore distribution market for Pictet Asset Management, and we're going to talk about Asia, investment opportunities, China and beyond. So Jorge, welcome.
Thank you, Alicia. Thank you, and thank you for joining us today. Today we're going to speak about Asia. We think it's not only due to the recent developments in China, but also because we think it remains the fastest growing economic region in the world. It is expected to house more than 45% of the middle class in 2045, be responsible for more than 50% of global GDP. We think this offers good opportunities for investors, but also risks. And today we wanted to talk about those two issues. To do this, I wanted to introduce my colleagues Kiran Nandra and Qian Zhang. Kiran joined us in 2016, and she's head of emerging equities management. And Qian has been with the firm since 2019, and is a client portfolio manager for emerging market corporate and Greater China debt teams. Both are based in London. So before we start, we wanted to show you a short video where Arun Sai from our strategy unit discusses where to find opportunities in Asia. And after that, we will give you a quick overview of both markets before digging into the panel discussion.
This is the first time since the 1980s that the yield of a global 50-50 portfolio is below expected inflation. As a result, global investors need to diversify into asset classes, markets, and themes in ways they've never done before. Higher yields, lower inflation, superior growth, and cheap currencies are, in our view, a compelling argument for emerging Asian assets. Among all of the asset classes we consider, we expect emerging Asian equities to deliver the best returns over the next 5 years. At 11% per annum, on our forecasts, emerging Asia should outperform US equities by close to 35% over this period. This would be driven mainly by superior earnings growth and currency appreciation. In addition, Asia provides natural diversification across economic cycles, with a mix of large countries with well-balanced sector mix in China and India, world leaders in technology through Korea and Taiwan, and a diverse set of smaller countries across Asia, such as Vietnam, that stand to benefit the most from growing intra-regional trade. Stocks within Asia are much less correlated to each other compared to other regions, and hence provide not just diversification benefits, but also more opportunity to outperform benchmarks through stock picking. Asia is not only the world's fastest growing region, but it is also arguably one that is transforming the most rapidly. These changes, from demographics and economic models to changing consumer behavior and corporate structures, bring several exciting opportunities. And despite a similar tilt towards tech stocks, Asia trades on a sizable discount to the US. But there would also be some pitfalls to avoid. The rapidly aging population in parts of the region, especially China, geopolitical tensions, the impact of climate change, and governance standards which are still catching up to the developed markets are key risks to monitor and navigate around. Careful consideration and active stock selection, we believe, is key. While there is some opportunity to gain indirect exposure to Asia through, for instance, luxury goods and miners, developed market companies have only had a mixed track record of success in expanding in Asia. Moreover, exposure across the fastest growing sectors is hard to achieve through indirect plays. We believe that the rapidly evolving market and regulatory framework is best navigated by domestic corporations. Chinese government bonds offer attractive yields in a currency we expect to continue strengthening. In our view, China's bonds are increasingly behaving like a safe haven asset class. Emerging Asian credit, on the other hand, offers opportunities to those seeking income, but without taking on the FX risk. So, What might be the optimal weight of Asia in a global portfolio? In our analysis, investors should almost triple the weight of Asian equities and bonds in their portfolios to hit a 4% real return, which is broadly in line with the long-term average. In our efficient frontier of expected 5-year returns, emerging Asia plays a prominent role. China's government bonds offer the best return to risk ratio of all the asset classes, while emerging Asian equities clearly offer a much higher return than other asset classes with a similar level of risk. On our forecast, the expected returns of such a portfolio, which also includes inflation-protected bonds, market-neutral funds, and gold, are more than double a global 50-50 portfolio for only a 20% increase in risk.
That was great, but before we proceed, I just wanted to remind you that after the panel, there will be a live Q&A discussion with your questions. So please feel free to post your questions throughout the panel through the WebEx app, or either sending us an email to info@fundsociety.com, and we will answer you later on. So Jorge, please.
Thank you, Lisa. So of all the opportunities that Arun mentioned on his video, today we wanted to focus in two areas, Chinese onshore bonds and Asian equities ex-Japan. So to set sort of the scene and make sure that we all understand what we're talking about, what are the markets, the structures, we're going to spend a few minutes with starting with Qian, talking about Chinese onshore bonds, and then Kiran is going to tell us a little bit about the Asian equities ex-Japan market. So with that, Qian, the floor is yours.
Thank you very much, Jorge, and good morning, everybody. So great to have this opportunity to discuss about Asia and China market with you. I think to start with, to set the scene, it's important to clarify what kind of market structure when we're thinking about fixed income assets in Asia. Largely speaking, there are two kind of markets within Asian fixed income. The first set is perhaps most of you are very familiar with, is US dollar denominated bonds issued by Asian corporates, sovereign, quasi-sovereigns, etc. Largely, they are a part of the global US dollar denominated emerging corporate universe, for example. And the second large part is local currency denominated Asian bonds. These are bonds issued by Asian, can be sovereign, can be corporate as well, but denominated in their own currency. In terms of size, the US dollar denominated Asian bonds market is about 1 to 1.5 trillion in size, but the local currency denominated Asian fixed income market is a lot larger, arguably mostly driven by the tremendous growth in the onshore China bonds market, which stands around 18 trillion in US dollar. So if you think about global aggregate bonds market is about 60 to 80 trillion. China onshore bonds alone nowadays is around 18 trillion in US dollars. So it's a very large chunk of the global bonds market already. And outside Asia, we're talking about another 4 to 5 trillion size in the rest of Asia in terms of local currency denominated bonds market. In terms of the risks they're exposed to, it can be quite different. When we are talking about US dollar denominated bonds, they are relatively more sensitive with US Treasury movement because they're priced by Treasury base rates plus a certain credit spread. So more or less you can think about them as more or less credit instruments. For the local currency denominated bonds, they obviously the main driver would be the local interest rate movement, the inflation dynamics domestically, and obviously the currency movement between dollar and that particular local currency. So they serve different purpose within the portfolio allocation concept. Within the US dollar bond market, you have more options In credit, for example, let's play a bit more on different sectors, potentially tapping into the higher growth opportunities within the region. And then with local currency market is more on currency appreciation, but more importantly, as the video mentioned, is the benefit of diversification. That is especially true for China onshore bond market, which is one of the very few truly decorrelating assets with not only global bonds, but also global equities or even nation equities. We can elaborate a little bit more in the later part, but largely speaking, these are two sets of Asian fixed income market and serve different purposes within portfolio allocation.
Perfect. Thank you, Qian. Kiran, maybe you can give us a brief glimpse of Asian equities and how is the market structured today?
Absolutely, and thank you very much for having me, and hello to everyone who's watching and listening. So yeah, I think just following on from what Qian was talking about, I mean, Asia ex Japan actually makes up 80% of emerging markets. And in terms of which sectors you'll be more likely to be exposed to, it's more IT, financials, consumer, discretionary, which actually maybe isn't that surprising, given how tech savvy the region is. When you think of countries like China, Korea, Taiwan, even India, actually, these are all countries that have really, that are almost the IT backbone, if you like, of the world. And their citizens have kind of almost leapfrogged and embraced technology in a way that actually hasn't been the case at all for developed markets. So that's a bit on the sector side. On the geography side, perhaps unsurprising that China makes up the biggest chunk of the region's equities at 40%. Now, that may seem like a pretty large figure, but actually that's even before we take into account A shares, which are a whole different part of the investment spectrum. So for those who were interested, so A shares are really China's onshore equity market, and until recently wasn't actually broadly available to many investors. And a small proportion of this $15 trillion market is now available via MSCI indices, but a vast chunk, so at least 80%, isn't. So I like to talk about A shares as almost being an asset class within an asset class. It really marches to its own drumbeat. It's so different to the rest of Asia in so many ways. It's 80% retail ownership, only 20% institutional, and for the most part, it's smaller cap than the rest of emerging market equities. And in terms of sectors, the makeup of the A-share market is also quite different to the rest of Asia. And even though consumer and tech is increasing, the key sectors in the A-share markets are financials, industrials, materials, and staples. So actually, in some respects, it's very, very complementary to the rest of Asia ex-Japan.
Perfect. Thank you, Kiran, for that. So just going back to Arun's video, he mentioned a number of different compelling reasons to invest in Asia. The number one, I think, being higher growth versus the rest of the world. But capital today is also being moved by ESG considerations. And I don't know if you can quickly talk about that and how is Asia kind of either leading or lagging the push towards net zero and focus on the environment.
Yeah. So I think I'm really going to take those two concepts hand in hand, one on the environment, but also just a bit of a focus on innovation as well, just because I think for us, we see these two massive structural drivers as being very, very, very linked. And I think just to take that first point, one of the clearest linkages is on the semiconductor space. Semis have a really, really critical role to play in green-abling or green capex, and that's really helping the region when it comes to energy efficiency, automation, electric vehicles, and just renewable energy expansion. There's a huge push across the region, and not just China, but also India. So semiconductors are really forming a bigger picture around the greening of the economy, and Korea and Taiwan in particular stand to be key beneficiaries of this massive structural shift. And maybe just turning back to China for a second, just because, and this links in a little bit to the whole regulatory reset, which has had a lot of negative press recently. But if you look past that very initial kind of shock, investor shock that we had at the outset, that regulatory reset is really driving a shift from growth first to growth sustainability, and kind of balancing that growth and that sustainability. So in terms of opportunities, this clearly encompasses green initiative, but also social aspects as well, which includes things like trying to address income inequality, which we think will very naturally lead to innovation in areas like biotech, medtech, pharma, and even things like insurance, if we're thinking about medical and retirement. So I think that whole push on the environmental side is also just spilling over a little bit into the social side as well. And I think that goes hand in hand with innovation.
Perfect. Thank you, Kiran. I imagine some of our viewers are asking themselves, this higher growth is not only going to benefit Asian-based companies, but also global companies doing business in Asia. Any thoughts on why specifically Asian corporates should benefit from these drivers and not European or US-based companies?
Yeah, so I think there's a kind of couple of like interlinked things, and I feel like I've spoken a lot about China, given it is one of the largest pieces of the region. But maybe just following a little bit from on the previous question as well, and I'll expand it in a minute. But ASEAN is showing a lot of promise on the innovation front. We're seeing new homegrown business models springing up. That's across ASEAN in particular. And that's specifically around things like e-commerce and digitalization. And we really find that some of those homegrown companies, they know their markets really well, they know their partners very well, and they know the regulatory landscape in addition. And I think that sets up the domestic companies much better than for their kind of international counterparts. Another example of that would be a country like India. India's clearly suffered from two quite punishing waves of the pandemic. And there we did see a delay in the pipeline of some of these homegrown businesses actually coming to market, being able to benefit from international capital. But I would say that the IPO pipeline in India is probably the strongest that it's been over the last 5 years. So we do see a slew of new offerings coming to market, and that homegrown story has really gotten a lot more legs recently. And then maybe just finishing up a little bit on India, I think if you want to kind of dive down a little bit more, Indian healthcare companies, for example, are a prime example of Asian expertise benefiting Asian companies. And sometimes India's called the pharmacy of the world, and especially when it comes to things like generics. And this is something that we expect to continue and actually even strengthen over the longer term.
Perfect. One last question for you, Kiran. Asia has sort of been growing, led by exports in the last number of decades. Going forward, trade tensions, in supply chain issues, how are these countries dealing with that, and is there a shift in the economic model to continue growing at a faster pace?
Yeah, so I think maybe when we had the beginning of the trade war, there was a lot of press written around how this was going to, really stymie Asian growth. People were kind of thinking this was the end of the Asian tigers story. Asia has traditionally been an export-led economy, but that's kind of slightly less the case now. There's a lot more domestic domestic growth that we're seeing. And so actually the trade war was never quite the killer blow for Asia. But I think in some respects what it's done is actually bring the region closer together. So we saw supply chains moving out of China and into surrounding regions. What key examples here would include Vietnam, Indonesia, and even to a certain extent Bangladesh. So actually the trade war helped initially to almost broaden the pie and actually spread activity across the region. And I think that's important because I don't think it's by chance that you also had RCEP that was signed into existence very shortly after. So this is the Regional Comprehensive Economic Program. And there's still clearly a lot that needs to be put into practice, but as a signal of intent in terms of getting all countries across Asia Pacific to sign one agreement where tariffs will be removed from 90% of goods that are traded within the region. That's a very, very powerful illustration of just how much the region can actually do when it works together. And I think it's very helpful for a region like Asia, where you have so much kind of self-propelled growth, to actually keep that almost within the region, if you like. So I think there it's trade tensions are definitely there, but I think with all these things, you've always got to try and spot where is the change, and where can you actually benefit from this.
Perfect. Thank you, Kiran. Stay with us. I have some questions for Qian, but we'll get back to you. Qian, another of the compelling reasons that Arun mentioned were higher yields in Asia, particularly if we see it in China. Can you talk a little bit about the structure of the market, and are these higher yields reflect of higher risk, or is just an opportunity that investors are not taking advantage of right now?
Sure. So let's again take a look at the dollar-denominated Asian fixed income, including China's offshore bonds and the China onshore bonds as two separate segments. Within the US dollar bonds market, whether you look at investment grade or high yield, comparing with the equivalent rated corporate bonds in the developed market, both offered a certain amount of credit spread pickup. So you do have a bit of higher yield when you're exposed to the Asia dollar market. And why is that? Partially it's because the higher yield is partially a result from the higher growth potential. They always go hand in hand. Higher growth potential normally support a higher base rate in some of the countries in Asia. The other thing, which is perhaps a little less known, is the support from the local investors. If you look at the new issues for US dollar bonds from Asia, 70 to 80% of them are bought by local investors. So like Asian pension funds, banks, insurance companies, etc. For them, these are the anchor assets. There's a bit of home country bias there, but for them, it's the long-term anchor assets. They're not visiting money coming in and out. So there's very strong technical support to support that higher yield as well. Not saying like everything is an opportunity but not a risk, but we do believe if you do your bond selection, your issuer selection, or credit selection correct, there is a higher potential for investors to be able to tap into these higher yield, in a word, lack of yield, but avoid certain potential defaults, etc. as well. So that's dollar-denominated Asian bonds market. When we look at local currency denominated bond market, especially China onshore market, the story is higher quality carry with very good quality and low correlation with the rest of the world. The China government bonds is single A minus rated, yielding around 3%. If you compare across the world, there's no single A rated bonds will give you that amount of yield. So, and then at the same time, as I mentioned, historically, it has delivered really, really low correlation with most of the world's other assets. So long story in short, including China onshore bonds in a broader fixed income portfolio can boost boost your yield and at the same time enhance diversification at the same time, which is especially what investors need when most of the assets, because of QE, have gone a lot more correlated than before.
Perfect. And I don't know if you have the figures with you, Qian, but is there an underrepresentation of Asian fixed income in global indices, or they are basically in line with what we would see in the western part of the world?
So by I mentioned about most of the Asian bonds are bought by Asian domestic investors. That indirectly tells about the under allocation from the rest of the world in that particular part of the market, relative to its population, relatively to the size of the economy, relatively to the contribution of the global growth, and we all know that. But what is even more underrepresented is the China onshore bond market. As I said, it's a quite big size, quite big portion of the global bond stock already, yet it has not really existed in most of the asset allocations across the major investors in the world. There is one very interesting piece of statistics saying if you take all the public traded bonds in across the globe, and you take every bond that is yielding 2.5% or higher, half of them is from China onshore. So that tells you it's perhaps the last big chunk of assets that still offer reasonably good quality. I mean, single A rated for government bonds and quasi sovereigns, but still offer you some yield in today's world. So I think the trend is one dimensional from now on, from a severe underallocated situation to gradually playing a bigger and bigger role in investors' portfolios within fixed income.
Perfect. Thank you, Qian. Kiran, a related question for you. Do these higher yields benefit Asian corporates? And what is the impact on equity prices, different sectors where you think there's a sort of competitive advantage?
Yeah. So at a very kind of, I suppose, fundamental level, when you simply have higher interest rates, you're getting a higher discount rate, and that translates into more attractive valuations. So that's on a purely fundamental basis. Now, looking at it from a bit of from a macro perspective, if those higher rates go hand in hand with higher growth, and generally our in-house macro team is anticipating a continued upswing in growth levels, that's actually a very, very positive backdrop for risk assets. That's a very general case. But I think always the devil is in the detail. And I think there are certain countries, for example, and there will be more divergence, and there will be certain countries that will benefit much more. So we have countries like India, which are expected to really kind of push ahead on the growth front. So in that scenario, even if we do get steeper yields, you've got that kind of increased valuation discount, but against a really, really promising macro backdrop. But the other country I think it's really worth keeping an eye on will be China. That's clearly the country to watch. And actually it's quite possible that we may actually see a rate loosening or a liquidity loosening cycle sooner than many market participants think, especially as China looks to kind of pivot away over time away from the real estate sector and away more into other sectors. So I think you may actually see rate loosening, which should actually just help equity prices a little bit on that side too. But otherwise, from a sector perspective, financials normally are the very, very kind of traditional sector or types of stocks that you expect to benefit from that steepening yield curve. And then along with that, typically there'll be other cyclical sectors, a bit like industrials and even consumer. So I think it's really important that, if you do have increasing rates and it goes hand in hand with a strengthening growth cycle, that's incredibly beneficial. But as always, it's really important to be very clear where you are putting your money. And it shouldn't just be it's not a one-size-fits-all response.
Perfect. Thank you for that. So speaking of China, and this question is for Qian, and we'll get back to you, Kiran, on the same topic. The internationalization of the renminbi. China is making a big push to become a more integral part of the global financial and banking system. They're opening the renminbi for foreigners. What are your thoughts on this? How is it going to move forward? And what are sort of the risks and opportunities for investors from this happening?
Yeah, it has been a quite long journey in terms of renminbi internationalization. In our view, it has been gradually decoupling from a traditional EM currency more towards reserve currency. If you think about what is needed to be qualified for a reserve currency, you need a major economy size. You need to be a major part of global trade. People can use it for settlement. You need a relatively stable government bond yield curve, and the currency will perhaps need to kind of hold value when there is a global crisis or market turbulence period. They first several points, like a major economy, major part of trade, that's a given already, everybody knows that. They last several points, which to some extent were evidenced during the turbulence around the pandemic Q1 last year, where you see actually the renminbi actually performed reasonably well, and the government bonds, China government bonds, performed more in line with the other G4 government bonds rather than traditional emerging market local currency bonds. So the last very important part is, in addition for the settlement in trade transaction in the physical world, it's also very important to create corresponding capital market for people who own the renminbi to be able to invest. That's evidenced by the multi-decade, especially in the past 5 years, opening of the financial market in both the bond and the equity market of onshore China. Kiran mentioned just now the A-share market is like 15 trillion. I believe both the bond and equity market in China onshore is the second largest in the world already after the US. So with this key stone of opening the financial market is a very important and necessary step in the whole journey of renminbi internalization as well. As I mentioned, it is an under-allocated market from a portfolio allocation perspective, and with this prerequisites gradually being put in place, we believe the continuous inflow to the onshore market in the many years to come is perhaps more or less within expectation.
Perfect, thank you. Kiran, your thoughts on the internationalization of the renminbi and how it will impact corporates?
Yeah, so I think maybe moving away from the renminbi, I think in terms of the impact that it has on, for example, financial assets. So China clearly, I mean, for China's equity markets to be more adequately represented in a way that actually reflects the size of the country's GDP, it's really clear that the country does need to liberalize and open up its financial markets. And that was a key goal that was mentioned as well in last year's 5-year plan. And for the most part, when you do see something in the country's 5-year plan, the government will set out very, very clear steps to actually be able to achieve that. So we're already seeing changes that are being made to the systems, to the country's system of financial assets. One of those things includes, for example, the need to expand household income sources, and that really encompasses encouraging development of investment products, employee stock ownership plans, so ESOPs, which aren't really a common part of how people are being compensated. But also I think one thing that we should expect from a corporate perspective, from an equity investor's perspective, is we should expect to see higher dividend payout ratios as the country tries to get to a more, I don't want to say mature, but a more kind of developed level of financial assets. We're already hearing about, for example, rural residents who are being encouraged to actually exchange rural rights for equity ownership. And so I think, in our view, the country is sending a very, very clear plan that they're going to try to encourage income growth via equity holdings. And I think this is one thing that we should be ready to, invest in and actually benefit from as investors. For example, we're already seeing the greater prevalence of exchanges. We've already got talk of new exchanges that are being set up. And I think what it means is that you're just getting a more developed financial system. So that goes hand in hand with what they've already said on the 5-year plan. And it will have, I think, repercussions as well on the domestic side. But I think the punchline is that we should expect to see higher dividend payout ratios over time.
Perfect. Thank you, Kiran. Let's shift a little bit topics and talk about inflation. Qian, Arun mentioned that they expect that inflation will remain lower in Asia. More recently, we've seen in the developed world record levels of inflation. I think in the US is the highest for the last 30 years or so. So your thoughts on the topic? What is China or the region doing differently to keep inflation low, and how is that affecting the fixed income market?
Yeah. So I think it's very important to understand why this divergence is observed between Asia, especially China's inflation dynamics versus the other major economy, which is US. First of all, from supply side, one of the main reasons is there is less supply chain bottleneck for these economies in Asia, especially in China, given COVID was contained quite quickly at the beginning of last year, and the manufacturing supply chain was largely being intact. And from demand side, on the other hand, the domestic demand remains recovering very, very slowly. Most of the biggest reason behind that is still quite some restrictions putting on and off to counteract the regional breakout of COVID in China domestically. So the demand side, unlike the US where everybody is hiring, everybody is buying things, the demand side in local China do not really support an overall price rally either. So that's from the supply demand side why the inflation dynamics remains quite benign. The other big reason is fiscal policy. It's not only China, I think across Asia, the relative size of physical stimulus is a lot more humble than the massive stimulus we see in the Western world, especially in the US. So correspondingly, as a result, the inflation impact from this is quite contained as well. We think in the longer term, there's another interesting point I always think is quite valid. In the longer term, the key deflationary factor for Asia economies is the popularity in the adoption of e-commerce. Even comparing with most of the Western world, these countries have experienced dramatic increase in terms of the adoption of digitalized in terms of buying things, goods, service, etc. And that, to some extent, is a driver to contain down consumer prices due to a lot of competition and also logistics enhancement. So it's a quite unique factor in our view for Asia economies, and in the longer term is a deflationary factor as well. So for fixed income investors, that's a good news. And then also it creates a good environment for policymakers to have the room to keep the monetary policy relatively accommodative, which is very important to do this all green financing, etc. Like the big gap we need from a capital injection perspective to achieve the goals on climate change, on sustainability, etc. So you need to be able to have accommodative monetary policy environment in order to put these financings, either it's green bonds or other financing instruments into place.
Perfect. Thank you, Qian. That was very, very, very interesting. Kiran, let's talk about the middle class, which in my intro, I mentioned that it's expected to, I think Asia is expected to account for over 40% of the middle class in 20 years or so. And when people talk about the middle class, they talk about purchasing power. But what about savings? How is maybe being less reliant on flows from overseas, to put it that way, having more savers locally? How is that affecting Asian banks and corporates?
Yeah. So, so maybe before we get on to on the savings side, I do want to just mention something on the consumer, because you're right, people do talk a lot about the consumer and the middle class, etc. But I think the nature of that middle class is also changing quite subtly. And some of this is linked to that push on common prosperity. That's not just in China, but we are seeing that this is actually spreading out across to other countries in the region. And to a certain extent, I would say that Asia is grappling with the same issues that people are dealing with in the West as well when it comes to things like income inequality. But perhaps just kind of taking it back to your question in terms of what does this mean on the consumer and the consumer purchasing power. I think there will still be that focus on prosperity, on maybe not luxury goods as much, but for example, a while back, some of the most popular, well-known corporates were, for example, kind of white liquor names. We would still see opportunities like that opening up, but rather than those opportunities opening up, I guess for the mega rich, it's going to be that kind of high-end, relatively premium segment. So in this case, rather than bottles that are retailing at $2,000 per bottle, we're looking at the types of companies that are able to provide goods for that aspirational but still affordable type of equivalents. And that also goes hand in hand with more of a push for national brands, which are more likely to be affordable than their foreign equivalents, whether that's in things like apparel or even appliances. But again, we're just seeing this kind of subtle shift from what's been a popular area of investment in the past. And then maybe just touching on your point here, I think financials are going to be an absolutely key arena for when it comes to this kind of savings rate changes. So I would expect to see, for example, smaller private banks, perhaps some of those more nimble specialty finance names that are able to very quickly move into segments of growth in a way that the larger incumbents or banks may struggle to do so. So I think here there are clearly a lot of opportunities. And I think, again, that the pie is there, it's getting bigger, but I think you have to be really careful as to where you're investing within that pie as you get more of a divergence in opportunities.
Perfect. Thank you. Thank you, Kiran, for that. I think we're sort of 5 more minutes for our part of the discussion before we open it for the Q&A. So one last question for the two of you. I mean, China has been on the news in the last couple of months because of the changes they're implementing at a corporate level in terms of regulation, and that has created a lot of volatility, but also in some cases, for a lot of investors, uncertainty, and it's making them doubt about the confidence they have in the country to invest there. Could you share your thoughts on this? Maybe we start with Qian and we finish with Kiran.
Yeah, sure. So our high level take is the regulatory tightening are more sector focused rather than anything that is broad based fundamental shift. In terms of the bonds market, luckily the main sector that is has a big represents in the bond world is real estate. The other several like TMT and also education sectors, they don't take a big part of the bond universe. So in terms of China's real estate, we do think it's still an ongoing story. It has challenges and opportunities present at the same time. However, when you look at most of these are like China high yield real estate bonds, across the globe, they are perhaps the most attractively valued bonds in the single B and double B sector. In a word lack of yield, it's at some point it will turn from a distressed scenario to a more credit selection based opportunity set to be taken care of. However, saying that, we do think the tail risk of a policy error of over tightening still exists. So our stance is more sticking to the higher quality names with good liquidity access who can survive this round of difficulties. We don't think the policy tightening is here to kill the sector. It's still a very, very important sector for the Chinese economy as a whole. And the valuation is perhaps getting more to a attractive zone if the credit selection is done with good due diligence. That's one. Number two is when we look at the onshore China bonds market, it hasn't been really impacted that much because most of the issuers from domestic onshore, they are in assets heavy businesses. So for example, utilities, oil and gas infrastructures, etc., as opposed to more service, etc. Business. So to some extent, they are strategically very important. Most of them are very large-scale state-owned enterprises with good standalone business as well. So largely speaking, they trade more like the interest rate instruments rather than a pure credit instruments in our view. So the Chinese onshore bond market continue to deliver the story of these high quality, good carry, low correlation in terms of what it provides in asset allocation portfolio. So I think going forward, that will continue to support the thesis of inflows to the China onshore bond market. For the dollar bond market, especially for China high yield, short-term volatility may exist, but at some point we do think individual credits may present very good valuation opportunities to be taken advantage of.
Perfect. Thank you. Kiran, your thoughts on what's going on in China, regulation, tightening, and the impact on equities?
Yeah. So I think a little bit carrying on from what Qian was saying as well, I think the two key things you've absolutely got to keep an eye on would be valuations and sentiment. So with now valuations on Chinese equities as a whole, we're talking about between 12 and 13 times PE. So absolutely trading at discounts the way they have done historically, and also versus developed markets. So I think that is one compelling thing, but that's clearly not enough of a reason to actually start thinking about investing. But I think the other key thing, which is very interesting, is the fact that sentiment is now at 2 standard deviation lows versus where it has been over the last 5 years. So as a firm, we have our own sentiment indicators, and those are showing that actually, sentiment towards Chinese equities has been falling, and that's very interesting. And because what it means is that it doesn't actually take a lot for that actually to reverse. When you've got low valuations, low sentiment, it tells you that a lot of the fear, if you like, has actually been priced into the market. And we're at that point now where we're getting to the point where that regulatory dust is settling and it's starting to look a lot more interesting versus where it did 3 months ago, 6 months ago. And remember, this is for a country that is we see as a long-term structural compounder. The long-term growth path for the country is very, very clear. You will have these cyclical or kind of almost transitionary periods where you do have higher volatility, but ultimately we would advise actually taking those as buying opportunities, just because you've got this incredibly compelling long-term structural case for the region. And I think on the regulatory side, again, if you were to look at at least for China, if you look at the 5-year plan, it's perhaps a little bit less surprising what happened. I think what was a little bit more surprising was the way and the speed with which some of these changes were made. And it's questionable whether in future the government may think twice before perhaps embarking on these changes in that way. That remains to be seen. But I think there's definitely a clarity there in terms of that long-term growth path, what the country actually wants to focus on. And I think that will be really important. That's one lesson I think a lot of investors will be taking away from this most recent episode on the regulatory side, which is that picking the right sectors, the right industries will become even more important. And importantly, within sectors, being able to identify the winners and those who are encouraged almost to take market share versus those that are lower down the pecking order. So I think that ability to be able to distinguish is going to be really important. But as I say, valuations are incredibly cheap. Sentiment is really, though, it doesn't take a lot for those markets to start moving again.
Perfect. Thank you very much. Alicia, I think we have some questions from our audience.
Indeed, yeah. We have a couple of questions that have not been addressed. And one of them is about the sentiment you were talking about, and it's touching on the geopolitical aspects of Asia. We have a question about the Taiwan issue, especially here in the United States. There's sort of a worry about what's going to happen between China and Taiwan. Do you have any thoughts about how that may impact investments in the region?
Yeah, so I think on the geopolitical side, I mean, I think your US listeners will know that better or closely than we do. That there is this kind of idea of structural or strategic ambiguity. So the way we look at it is that Taiwan is still very much the key producer, for example, of semiconductors, semi-foundries. It's a key part of global supply chains. That in and of itself, I think, prevents a situation from getting out of hand more quickly than people may expect. And for example, we are we're very comfortable with some of those Taiwanese positions, especially on the semi side. Excuse me, for that reason, my phone just fell out. So I think as I say, we do have positions there. It's very difficult to actually take a stance and say, look, we think this is going to happen or that is going to happen. But I think the fact that it is such a key part of global supply chains, I think actually is very helpful for the status quo, shall we say.
Okay, thank you very much. And now maybe a question for Qian. You talked about real estate bonds in China, and of course, there is still a lot of worry about what happened with Evergrande, that scare we had. But you also mentioned that the opportunities are around the corner. Do you really think that valuations are already attractive to go into these bonds?
So I think the first key word is issuer selection. We probably have 50 to 60 issuers within the dollar bond universe from China real estate sector. That sounds a lot, but the background is the real estate sector in China is a very segmented one. If you look at the vast universe, who may not have bonds or who may not have US dollar bonds or may not even issue bonds, you have more than 80,000 real estate developers. So it's a very segmented market. It is due to experienced a high level of consolidation, which Kiran kind of alluded to. It's perhaps in the mind of the policy direction as well. They want the industry leaders to take the lead, and then for the ones who are doing the good job to deliver, maintain growth, but deleverage at the same time. So I would not say like all of the 50 to 60 different issuers are all in very good valuation conditions. Some of them may may die, some of them will survive in the end. There's a lot of differentiations among these issuers. If you look at some of the issuers, they do not have bond maturity until say 2023, so no liquidity concerns as the others who may have bonds that is maturing by the end of December, for example. There are others who have a lot better land banks than the others, a lot better projects than the others. So when they want to raise liquidity to sell, while selling assets, those ones who with good land bank and good projects will have a better chance to raise money than the others with relatively weaker projects, for example. However, I mentioned about the tail risk of a policy error. There is a potential tail risk if the tightening policy keeps for too long, and that dramatically undermined all the financing channels that is available for the real estate issuers, i.e. no matter how good projects you have, you just can't raise money by selling it to anybody else. It's a tail risk, but there is but we don't think in the longer term all of these leading 50 to 60 bond issuers will die. I mean, there's still structural demand for housing upgrade, and there is upstream, downstream within the among the real estate sector and the supply chains. And as a big employer, from an employment perspective. So my short answer would be yes, for certain good quality ones with less liquidity issues, they inevitably have gone punished by the sentiment, and they might sooner or later come to a point that it's perhaps worth of taking a look in terms of the valuation attractiveness.
Thank you very much. We have time for one last question, and that's passive investing. Is it gaining traction in Asia, and does it make sense? Can you please, Kiran, tell us what do you think? Thank you.
So I think just given what we've covered so far in terms of just being able to make that distinction across sectors and then within industries, I think active is absolutely the way to go. I think the ability to pick the winners and to sort out the winners from the losers is going to be critically important, and you'll see much more of a divergence in the future than you have seen in the past. I think that doesn't matter just for the likes of China, but that goes across ASEAN as well, and we're seeing it already. You're seeing those kind of new movers, those domestic business models, and those kind of those winners just increasing their market share. Sometimes at expense, and rightly so, of some of the weaker players. So I think active is absolutely the way to go, and I think passive is making less and less sense in terms of how to invest on the equity side.
Okay, thank you very much. Actually, we do not have time to continue, but it has been really interesting. I just want to remind everyone that this has been recorded, and we will be sending the recording shortly, probably tomorrow, to all of you. And Jorge, thank you very much, as always. Thank you to Pictet Asset Management. Thank you, Kiran and Qian, for being with us. Well, have a great rest of the day and rest of the week. Thank you.
Thank you, Alicia.